Over the past 3 months, markets continue to live for the moment, appearing less bothered about the gathering storm clouds from the slowing macro environment. If we cut through the Wall Street noise, 3 key themes for Q2 were central banks continuing to battle inflation, narrow market impacting stock selection and factor alpha, and a diverging fortunes in Asian equities. The US Federal Reserve, ECB and Bank of England and other central banks continue to raise interest rates in their attempt to tame inflation. The consensus is that we are closing in on the peak of rates, but the end game remains far from clear. Unemployment remains stubbornly low and there is no historical precedent for high inflation to be calmed without rising unemployment. We have witnessed an incredibly narrow market rally, led by mega-cap, artificial intelligence exposed stocks. To put this into context, the top 5 contributors have accounted for over 60% of US stock market returns year to date. Historically, narrow market leadership typically leads to slower growth for the following year. Time will tell if AI leads to the much hyped productivity boom. Finally, a post-pandemic glow definitely returns to Japan, with the economic malaise or mist starting to shift inflation up. Consumer spending has continued to rise and foreign tourists are back. Japanese equities are up more than 15% on the quarter, but be careful of the currency. A weakening yen has meant the euro-based returns have only been 6%. Even so, the story has been much more sobering across the other side of the East China Sea. China has delivered a lackluster post-COVID reopening. Chinese consumer sentiment remains poor, battling weak housing market and high youth unemployment. Thus far, limited stimulus has yet to spark the domestic equity market into life. Our slight underweight position in equities has not delivered so far in the second quarter, but we are increasingly see the risks to the downside for the second half of 2023. The narrow mega-cap tech rally is papering over the cracks. Bigger is not always better, especially when the entire market returns rely so heavily on a few mega-cap stocks. The market has never been so top-heavy since the TMT bubble at the end of the 90s, with a very small number of market constituents outperforming the broader index. The AI or ChatGPT theme appears stretched, given it has generated $1.4 trillion of market cap this year. We prefer to stay away from investor herding and focus on the fundamentals, which are pointing to a slowdown in the near-term economic growth. The momentum and short-term indicators have prevented us from going more underweight risk at this point. There are more casualties ahead from the rapid increase in interest rates. The LDI spasm, commercial property defaults, and regional bank crisis in the US were the first taster of the collateral damage from hiking rates. But it is unlikely to be the last. Higher rates are drying up liquidity and putting the commercial property sector under pressure. At the same time, high yield default rates are starting to rise as banks are tightening lending standards to corporates. And the least liquid part of the spectrum, private assets, are facing more and more scrutiny given that they have been the major beneficiary of cheap money over the last decade. The severity of the recession depends if central banks and bond vigilantes accept higher inflation for longer. Whilst inflation has cooled somewhat, the magical 2% target core rate that the Federal Reserve talks about is still a long way off. To get to these levels, demand and economic growth have to fall much more dramatically than we have witnessed so far. Right now, US households are leaning on credit cards and as wage growth isn't keeping up with inflation. But this is not a long-term fix. We expect inflation to be more sticky than the market consensus. Whether or not central banks are prepared to raise their target inflation rate to circa 3% is likely to be the deciding factor whether we experience a soft landing or a more severe economic downturn, which would be a hard landing. Over the quarter, the portfolio was up around 0.9% in absolute terms and somewhat behind the benchmark. It was really a tale of two stories. In asset allocation, we detracted value, but the stock selection was positive. So the asset allocation Q2 performance was a slight drag. A slight underweight in equities overall hurt performance. And given the magnitude that bonds trailed equities over the quarter by over 6%, hawkish comments from central banks pushed up bond yields, which have an inverse relationship with bond prices. An overweight in emerging market also detracted from performance, weighed down by China's consumer unwillingness to wake from their post-pandemic slumber. A small allocation to commodities also detracted, although the sell-off here slowed from earlier in the year. Security selection alpha was positive in Q2. An overweight to emerging market was less costly due to the alpha from security selection in this part of the portfolio. Similarly, the Robeco QI developed enhanced equity index outperformed the broader equity market. This was impressive given how narrow the market rally really was over the quarter. At the headline, the portfolio remains slightly risk-off mode, and we have further to reduce our exposure in parts of the markets that we think could be sensitive to a global slowdown. For instance, we have reduced our allocation to high yield, taking note of the rising default rates. In the same vein, we have cut our exposure to commodities over the quarter. On the flip side, we've initiated positions in Robeco QI multi-factor credit as it offers investment grade exposure. It also focuses on bonds with low level of expected risk, attractive valuations, strong performance and momentum, and small market value of debt. We have also introduced the Robeco Sustainable Global Stars, which is a high conviction fundamental equity strategy with strong quality focus. We retain the overweight in emerging markets, principally on valuation grounds, and emerging local currency bonds on the attractive yields, the high real interest rates, and the diversification benefits.